So I get asked this question a lot. I hear, Ben, well, I have all the student debt. I don't think I'm going to qualify because of it. To which I then come back and ask, well, how do you know? Because in order to know, you have to know how a mortgage company decides whether to approve you or not. You have to know the decision criteria. Okay, just because you have or might have tens of thousands of dollars worth of student debt to your name doesn't mean you can't qualify to buy a home. Believe it or not, mortgage underwriters don't necessarily look at the total amount of outstanding debt that has to be paid off or has to be paid eventually by you in the future by you to qualify you or not. Instead, they focus on the minimum monthly payments that have to be paid that result from all of those debt balances. So they look at the minimum monthly payments that come from your credit card, student, personal, auto, and this new home obligation. And on the new home, they count the principal and interest payment, the monthly property taxes, home insurance, mortgage insurance, if any, and then condo or HOA fee, if any, to determine your minimum monthly home payment. And then they take all those minimum payments and they divide them by your gross monthly income, okay, your pre-tax earnings. So this gives you a percentage. It's then called your debt to income ratio. It's one of the three main things that mortgage companies look at to qualify you, the other two being your credit and your savings. Now, if the student loan debt is in a grace period and doesn't carry a minimum monthly payment yet, the mortgage company almost always takes either 0.5% or 1% of the balance and uses that as a hypothetical monthly payment minimum for you, because you have to pay it back at some point, and we have to somehow factor that into your ability to repay mortgage requirement. Okay, so now let's put this together with an example. If you have $10,000 of student debt and we count 1% of the balance as your payment, then 1% of $10,000 is $100 per month. So by carrying that debt, it reduces the maximum monthly mortgage payment you can take on by that $100. So that's usually not so big a deal, not so much a make or break point there. Then example 2, if we count your student loan payment as 0.5% of the balance and you have $50,000 in student debt, then 0.5% of $50,000 is $250 a month. And so that's what would then reduce your maximum monthly mortgage payment you could afford by, is that $250 a month. Now, depending on loan type, we'll use, just like I said, 0.5% or a full percent for you in this calculation. And you can get rid of your student loans to qualify, but there's other things that you can do that will improve your debt to income ratio and with much greater effect than paying off your student loans, and which would cost you much less money to do so. So don't do that. Very important point here. The only time you should really be paying off debt to qualify for a home is after you apply and we see how much of your debts individually impact you and your qualification. Okay, you don't know that whole picture. You don't know what changes could help you and by how much, so just wait on that until we give instruction. But guys, thanks for watching, and do your closest friend a favor who's going to be buying a home in the next year or two. Go tell them about this channel, tell them to subscribe, tell them about the favorite videos that you like on this channel, and tell them to eventually call me for help. Thank you.